The Jillaroo Superannuation Fund was created in 2002 and it has 4 members.
The 4 members are Ethel and Ernie Ferguson and 2 of their employees, who are also their sons.
Ethel and Ernie conduct a business that trains young people in the skills necessary to work on outback stations. The business is conducted at Cloncurry in northern Queensland on a 500-hectare property. Shortly after the Jillaroo Superannuation Fund was created, it acquired 100% of the units in a newly created trust called the Jackaroo Investment Trust. The trust purchased the property on which the training business is conducted. Ethel and Ernie pay an arm's-length licence fee to the Jackaroo Investment Trust to use the land owned by the trust to conduct the training business. Each year, the trust distributes its net income to the superannuation fund. The trust has not borrowed money from any party and it does not own any interest in any other entity.
The trustee of the Jillaroo Superannuation Fund is Ferguson Proprietary Limited. The trustee of the Jackaroo Investment Trust is JIT Proprietary Limited, and this company is controlled by Ethel and Ernie.
On 1 May 2013, one of its employees, Darren, gave notice that he would leave the employ of Ethel and Ernie on 30 June 2013. Ethel and Ernie immediately set about finding a replacement employee.
After searching for about 5 weeks, they made an offer of employment to their daughter, Karen.
She commenced work with them on 14 June 2013 and invited her to become a member of the Jillaroo Superannuation Fund, which she accepted. On 30 June 2013, Darren ceased to be employed in the business and also ceased to be a member of the Superannuation Fund. What are the implications of these events under the superannuation supervision and tax legislation? If the market value ratio of a superannuation fund's in-house assets as of the end of the year of income exceeds 5%, the trustee of the fund must prepare a written plan setting out the steps by which the trustee will dispose of in-house assets such that the market value ratio does not exceed 5%. Further, if the market value ratio of the fund's in-house assets exceeds 5%, the trustee of a superannuation fund must not acquire any more in-house assets. An in-house asset of a superannuation fund includes an investment in a related trust of the fund. A related trust of a superannuation fund includes a trust that a member of the fund controls. Among other things, a member or group of members of a superannuation fund will control a trust if those members have the ability to remove or appoint the trustee of the trust. This means that Ethel and Ernie control the Jackaroo Investment Trust, and the investment in this trust by the Jillaroo Superannuation Fund would normally be an in-house asset of the fund. However, under the superannuation industry supervision regulations, an investment in a related unit trust by a superannuation fund can be deemed not to be an in-house asset. There are a number of conditions that must be satisfied in order for this to be the case. These conditions include: 1. The superannuation fund has fewer than 5 members. 2. The trustee of the unit trust is not a party to a lease arrangement with a related party of the superannuation fund unless the lease arrangement is legally binding and relates to business real property. 3. The unit trust does not have outstanding borrowings. And 4. The assets of the unit trust do not include an interest in another entity. There are other conditions, but they are not referred to here. The Jackaroo Investment Trust does not have any debt and it does not own interests in any other entity. Therefore, conditions 3 and 4 are satisfied. It does, however, have a lease arrangement with a related party. The subject of the lease arrangement is the property on which the business is conducted. This property will meet the definition of business real property, as the property is used wholly and exclusively in one or more businesses. Accordingly, while the fund has fewer than 5 members, the investment in the Jackaroo Investment Trust will not be counted as an in-house asset of the superannuation fund. Under the tax law, trust distributions received by the superannuation fund will not be considered as non-arm's length income if the acquisition of the units by the fund was at arm's length and the amount of the trust distributions is not more than the amount that the fund might have been expected to derive if the trust and the fund had been dealing with each other at arm's length. The problem for the fund arises when Karen becomes a member. At this time, the fund has 5 members. This situation continues until Darren is no longer a member of the fund. Although this is a period of only 2 weeks, one of the conditions required for the Jackaroo Investment Trust not to be an in-house asset of the fund has been breached. When this occurs, the superannuation regulations cause the relevant assets to become in-house assets. Accordingly, the units in the trust will become in-house assets of the superannuation fund. Also, the units in the trust and any future investments in that trust can never again be excluded as in-house assets. This will be the case even when the number of members of the fund again becomes fewer than 5 after Darren ceases to be a member. Depending on the value of the assets of the fund that are not in-house assets, the fact that the units in this trust will be forever in-house assets may cause the trustee of the superannuation fund to have to dispose of the units in the Jackaroo Investment Trust.